Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson and Tom Mackenzie. With the cash trade just less than an hour away, here's what you need to know. Global bonds fall after lukewarm demand for 10-year treasuries as the Fed's Susan Collins gives another indication that inflation may take longer to tame than previously thought. BOE Decision Day, the Bank of England is expected to hold rates at a 16-year high. We will be outside Threadneedle Street all morning. Plus, it's now hostile. BBVA launches an all-share deal to take over smaller rival Sabadell after a voluntary approach was rejected.
OK, let's check in these markets. Markets seem to be screaming out for some kind of catalyst. European futures currently pointing lower by about 0.1%. The FTSE 100, though, getting a bit of a lift from the commodity story. Iron ore getting a pop on the linkages to the China real estate policy story that continues to evolve. Up 0.1% is what's being flagged on the FTSE 100. We watched the miners. 450 on the US 10-year after that auction wasn't particularly well received. 42 billion yesterday. Yields up 1 basis point after a 3 basis point move yesterday. Euro dollar 107 on the single currency. We'll look, of course, at the pound as well on BOE Day. The show starts right now.
Significant amount of uncertainty around that outlook, and the recent data lead me to believe that it's just going to take longer than previously thought.
Boston Fed President Susan Collins there talking about the fact that she thinks the Fed is going to have to wait. Other central banks not so sure. We are now firmly into the central bank sequencing game. Good morning, everybody. Thursday, the 9th of May. We've got a lot to talk about. It is Bank of England Day. Others have gone. So we've now had the Riksbank, you've had the S&B. You potentially could get hints today from the Bank of England about a June rate cut. Potentially we could be talking about a June rate hike from the BOJ. But the Fed, guys, increasingly feels like an outlier. You listen to Collins there. She's talking about the fact that we're going to have to wait. The US economy feels like it's in a very different place. The Bank of England feels like it's got enough cover now to start to sound a little bit more dovish. The S&B's gone, the Riksbank's gone, the ECB's sounding pretty dovish as well. We can park the Fed to one side, maybe.
Well, maybe. Maybe it does stand alone. Maybe it's more of that US exceptionalism, or maybe the Fed, maybe the US starts to display some of the same symptoms we're seeing elsewhere, but it just takes longer to get there. I know we've got a guest on later who's talking about some of the slowing in the US economy becoming increasingly evident.
Chatham Financial, speaking to them earlier on the 6 hour, and they were saying that absolutely the BOE can diverge now, and that to some extent, to your point, the Riksbank and S&B does give them the cover. And the idea that there's this gravitational pull of the Fed so strong that you can't break away is completely overplayed. The inflation question, though, for her was the external shock risk. That's the only thing that derails the downside coming through from inflation. That was the thing that she watches. But otherwise, she sees that inflation story evolving here in the UK in a positive direction for the BOE.
I also wonder if we get too preoccupied with when they start rather than the pace at which
that's a really good point.
You know, and I think we've got guests coming up with views on that as well. And the Riksbank maybe gives us something to think about there, because they move, but then very clearly signalled we're not moving again in June. So, you know. No,
but they did signal we've got 2 more rate cuts coming potentially this year. So they are signalling very clearly that there is a cycle that is emerging here. I think 2 is kind of not really a cycle. 3, I think, probably makes it a cycle. So I think maybe the Riksbank is giving us that clue. And it'll be interesting to see how, if we get a dovish tone from the Bank of England today, how markets react. The FTSE 100 has been performing very strongly recently. Part of that, you could argue, is down to what we've seen in sterling, which has been signalling some weakness. But the economic data, and I'd be interested to see what happens in the BOE forecast as well, also signalling that actually the economy looks like it's doing relatively better, certainly than the Bank of England's expectations. So there's maybe some domestic-generated growth that markets, maybe the 250, can price in as well.
And whether there's an adjustment in gilts as well, because there's been some selling pressure and the argument that for some, maybe it's been a little overdone in terms of sell-off in gilts. Of course, Lizzie is standing by. Lizzie Burden, I believe, outside the Bank of England with that preview. She's going to be following the story for us in all the granular detail. And, of course, she has those insights. Lizzie, talk to us about the expectation around this potential dovish tilt then from Andrew Bailey and co. What kind of clues we may be looking at?
Well, Tom, I've worn yellow for you today as a representation that the Bank of England is still in wait-and-see mode. We're not expecting a cut today, but as you say, the focus very much on whether they start in June or August and then what happens after that. So in terms of the clues, first of all, look at the language in the guidance? Do they start saying that cuts are coming in the coming months? Do they go like Christine Lagarde and point to which data points they're watching as for clues as to when to cut? A suggestion of whether it will be June or August. Also mind that vote split. Does Dave Ramsden, the Deputy Governor, join Swati Dhingra today, make it a 7-2? Because we've had this dovish tilt in a recent speech from him. And as you mentioned, the forecast, all important. If they show inflation dropping below the 2% target, given that it's predicated on the market curve, it would suggest they think the market is actually being too cautious in its pricing for cuts at the moment. But the press conference is going to be dominated by this question, Tom. And for the governor, it's going to be really difficult when it gets to August to put off the hiking if the ECB, the cutting, I should say, if the ECB's already done it, and when you've got such pressure from politicians. Jeremy Hunt already saying that it would be a feel-good factor if the cuts started to come.
Yeah, I think it was a famous central bank governor, maybe from the ECB, that said, "I hear but I do not listen," when talking about some of that political interference that comes when we talk about the independence of central banks. Lizzie, great stuff. Thank you very much indeed. Lizzie's going to be back throughout the morning. We've got some great coverage lined up for you of that decision that is coming from the Bank of England at noon London time today. Special coverage of the decision and, of course, of the press conference for viewers in the UK. If you want to watch it elsewhere, you've got some fantastic functions that you can use on your Bloomberg terminal, TV Go, and also the YouTube channel will provide you an opportunity to watch what is happening with the Bank of England. If you want to read about it, TLIV Go, the top live function, will be there as well. And, of course, later in the day, we will bring you an interview with the Governor of the Bank of England, Andrew Bailey. I think we've got it pretty much all covered.
I think so. That's a lot.
That's a lot.
That's a lot of coverage.
We're going big on the Bank of England today.
We are going big on the Bank of England. I mean, it'll be interesting. There'll be plenty that comes out of it. There'll be new guidance around inflation and growth expectations. Yep. So there will be new stuff there. But will there be clearer messaging around when we get those rate cuts? I just wonder, because if a lot of other central banks are being increasingly data dependent and that takes us into more volatile territory, are we wrong to expect more?
If they signal that we are getting close to a cut, is there going to be some sort of data that they need to see? Do we need to tick a few more boxes? We need to see this happen and this happen in order to get us to the point where we can deliver that cut? Yeah,
maybe. I was looking back at the inflation picture, though. Every time that they've cut in the last 20 years or so. And what's really interesting is that there's not much experience of cutting in quote-unquote normal times. I'm not sure what that means anymore. But, you look at the last times they cut. It was the COVID pandemic. It was Brexit vote. It was GFC. Yeah. These are the last times that the Bank of England has cut. And that's going back a very long time. So there's no recent memory.
In the midst of crises.
Yes, absolutely. Absolutely.
So this feels like a normal economic cycle?
Yes, which is new.
Which is, yeah. Well, we'll see how it plays out.
Old and new, all at the same time.
I think the Fed question is still going to be an interesting one. I still think it'll be interesting to see kind of where the Bank of England aligns itself. Is it halfway between the ECB and the Fed, or is it probably more closely aligned with the ECB's orbit? And what does that tell us about also the economic story around the UK as well? Yeah,
and to that point, it seems like the ECB and the Riksbank are seeing things in terms of data, in terms of clarity, to give them the confidence to give some sort of guidance. We were talking about the nature of that guidance earlier, but they're giving that guidance where the BOE so far hasn't been able to, and certainly the Fed hasn't been able to, but Bailey is turning more dovish.
Inflation in this country is much higher. And some of that is structural. Some of that has come through from what is happening with the minimum wage. Some of that's coming through in the service sector, which is still struggling because of what is happening with the immigration story. A friend of mine runs a pub. You talk to him about kind of labour, and he'll tell you how...
about inflation.
Precisely. He genuinely has this... He talks about it a lot. It is a real struggle to find the people he needs and to kind of figure out how you make the margins work when you're having to pay your people this much more. And it's a real struggle.
Well, we've started here talking... We've been talking a lot about rate cut expectations, and one of the things that gets excited when you talk about rate cut expectations is more capital markets activity. We've seen a little bit of that going on, haven't we, with the Spanish banks, the ongoing saga around what's going on there. And we've seen this morning it's gone hostile, as we said in our headlines. Another offer then for Sabadell from bigger rival BBVA, trying to bring together something that takes on Santander.
Hostile takeover offer.
Hostile takeover. A day after Sabadell published put out there in the public domain a letter they'd received from BBVA that said why they can't go any higher in the offer, and Sabadell published that.
Yes.
You know, things getting a little tense in Spain, it feels.
Described as a voluntary tender that's hostile. So a voluntary hostile tender, an all-share takeover.
Yeah.
So really interesting in terms of the idiosyncratic stories around BBVA and Sabadell. But more broadly, and this is something you're nodding to clearly, Anna, is the capital markets question around this and what it signals. We were speaking to a bank analyst earlier this week who said, at the very least, it says and suggests that you could see more consolidation in the Spanish market. Maybe too early to read into that consolidation that we've been waiting for so long in the banking space across Europe. But Spain, maybe this is the signal.
But this is the problem. Doesn't this just entrench the idea that actually you have national champions in Europe? You don't have regional champions in Europe. UBS, a classic example. Now, that was forced upon it in so many ways. But here we've got a national champion being created. Is that what Europe is? Is that what the Capital Markets Union is about? Is that what Banking Union is ultimately about? It should be a single set of rules across the whole of Europe, which means you can operate across the whole of Europe. But we're almost with these deals entrenching the idea that you've got a national champion, which is going to make the latter more difficult, maybe.
Or two national champions, perhaps, in the case of Spain.
Yep.
Interesting on the subject of M&A, I saw that Wood Group putting out a statement this morning, and just yesterday they rejected a takeover offer, this in the oil services business, and they're putting out details of how they think they can deliver significant free cash flow in 2025. There is just a lot of this happening at the moment. These offers coming in, being rejected, businesses holding out for more. It does, entirely unscientifically, the mood music around M&A feels a little brighter.
Yeah, it seems like it's good news for the investment bankers out there focused on M&A. There's been a pickup, particularly here in the UK as well. A reminder, and we're going to be discussing this with one of our guests later in the show, around the valuation that's clearly being seen by the private markets, but maybe not necessarily by the public markets. We've picked up a bit in terms of the FTSE 100, up about 8% year to date.
Well, precisely. So there has been at least some recognition of this, finally, belatedly, in what is happening with the FTSE 100. But maybe you get a dovish Bank of England today. Sterling takes another hit. The Fed's sounding pretty kind of hawkish at the moment, you could argue. Do you see sterling going down? Does that undermine the case for buying the FTSE 100? I think that's an interesting one. The 250, I think, is a different case. Be interesting to see what the growth story looks like. I'll come back to that.
One company that is not on the FTSE 100, but many in the UK would still wished it were, was Arm.
Yep.
Although we saw the stock down as much as 10%, so maybe that's a lucky escape. But it's been up by 40% year to date. Lukewarm guidance coming through from this business. And, Tom, you've talked to the Arm CEO many times, of course. This is all about the data centre pivot, isn't it? This is about moving from one set of customers to another, not full scale, but adding those in. And interestingly, from some of the writing this morning, increasingly competing with their own customers, the likes of Qualcomm, as they move further into the data centre business.
You can forgive investors in this company for feeling a bit of whipsaw, because it wasn't that long ago when I sat down with René Haas, he was having to make the case that this is real, that they can get exposure to the AI story, and at that point the stock was under a bit of pressure. Then you had this massive run-up. They came out with some results suggesting that they are feeding into this ecosystem. Big pop in the earnings, and now, I think there's a lot of heavy lifting being done by Warm in terms of the lukewarm comment, because they weren't that bad, but it's about the expectations that have been built into this AI story. It's not that bad. They haven't downgraded their forecasts. They're still seeing growth.
Is there a bigger AI story here? That I think a lot of people are trying to figure out whether or not they are because they're right at the kind of the beginning of the process. If they're starting to signal. Caution maybe is the wrong word, but is there something in here that tells me that maybe actually some of this huge spending that we've been seeing around AI, there are cracks beginning to appear within
Well, it talks to the sustainability question in terms of the cash. We've got the energy question, but in terms of the cash and the massive spend, the tens of billions of dollars that companies have been spending on this infrastructure. And at some point, that's going to have to flatten out, at the very least, isn't it? And that's the question. Is Arm now signalling that spend on $30,000 chips is now starting to flatten out?
OK, we're going to be hearing from Arm CEO. You've spoken to him in the past, Tom. We'll hear later in programming from René Haas. He's going to be speaking to our colleagues Ed Ludlow and Caroline Hyde in the US. You can catch that interview on Bloomberg Technology. That's at 4 o'clock UK time. So that's the US earnings stories wrapped up. Let's have a quick look at what lies ahead for us then in terms of our trading day ahead. 11 a.m. UK time, we have the AGM taking place at Barclays. Once again, a climate theme in focus there, it seems, at least for some investors. London time, noon, we get the Bank of England rate decision, of course. 1:30 p.m. UK time, US jobless claims. 6 o'clock London time, we'll have a 30-year bond auction. We talked about the one from yesterday already. And China's President Xi continues his visit in Europe. Today he'll be in Budapest. And finally, central bank policymakers will be speaking at events throughout the day. I think David Cameron is also speaking, the UK Foreign Secretary, and talking about the importance of higher NATO spending. 2.5%, he says, should be the new benchmark.
I should just make a clarity. I said $30,000 chips. That's in relation to NVIDIA, not ARM's chips. But ARM's chips accompany those NVIDIA chips. Just for the clarity, $30,000. I'm referring to NVIDIA, not ARM. In terms of the Treasury story, and we talked to Mark Cranfield from MLive about this earlier. So it wasn't well received in terms of 42 billion of 10-year, and he was suggesting it really sets us up for a struggle today with the 30-year auction.
Right. Yeah, absolutely.
Particularly given the Fed speak.
Yeah, given the Fed speak. And I wonder, the market does feel a little generally directionless, waiting for the inflation print next week. Is that it? Or are we waiting for June now and see if we get any of these global rate cuts?
What is the catalyst? I have no idea.
Yeah.
It could be the CPI prints.
Cranfield was saying the CPI print next week is going to be huge. Huge is the word he used. And he said cross-asset.
When you say its
really
impact or its scale?
The market react... Well,
okay.
Yes.
Let's hope the numbers are huge.
Yes, we should clarify that. The potential market reaction, the significance of that data print, because there's a dearth of other information, that CPI print next week is going to be really consequential from my MLive team.
OK. There's tensions kind of growing, aren't there?
Yeah.
What is happening with Japan I find interesting as well. The fact that they've basically been forced, the BOJ, by the market and by the politicians, it feels increasingly, maybe to make June a live meeting. I think that's going to be fascinating. And I don't think we can underestimate the impact of higher rates in Japan as well on global bond markets. That's something else you're going to have to feed back into that Treasury story.
I do find it funny, though, the way that the Asia session played out, where the yen gained after we saw what seemed to be some hawkish commentary from BOJ officials saying they're closely watching the weak yen impact on the economy, and then everybody remembers that interest rate differential and the yen, it retreated again.
It went the other way.
Yeah, exactly. So, yeah, some level of focus on the yen does not remove an interest rate differential.
No, and it's a substantial one. OK, what are we going to talk about next? We're going to get back to that central bank policy chat. Fed speakers indicating inflation will take longer to tame. On this side of the Atlantic, of course, it is Bank of England decision day. We've definitely got that story covered, Tom.
Later in the show, we're going to hear from my exclusive interview with the DeepMind co-founder and CEO, Demis Hassabis, about some potentially groundbreaking developments in AI healthcare. Here's a little snippet, then, from that wide-ranging conversation.
AI is overhyped in the short term and probably underestimated over the long term, like what it's going to bring. And I think that's probably true of a lot of breakthrough technologies.
Welcome back. Still plenty of earnings that we need to be digesting. We'll get back to that a little bit later on. But let's focus now on what is happening with the macro story. It is Bank of England Day, of course, here in the UK. Joining us now, Tim Graff, Head of Macro Strategy for EMEA at State Street Global Markets. Morning, Tim.
Morning, guys.
So, if the Bank of England's dovish, the strategy is what? Sell sterling, buy UK assets, buy the FTSE 100, buy the 250, buy gilts. Is that is it that simple?
I think you've summed it up. I think we're done here.
Excellent.
Yeah, great.
What if they're not? Is it just the opposite trade, or do I just wait? Is that trade on still? How does it fit together? And what are you expecting, by the way?
Yeah, no, I would expect them to be a little bit dovish. They've already been dovish. The Bank of England has already adopted an easing bias. They did that at the last meeting. The commentary since then has really done nothing to change that view, and the data have justified that. And so a cut is coming. I suspect it's most likely still in August, but we get the May CPI data the day before the June meeting. If that is weak and it gets inflation due to base effects, due to just current period weakness, back towards target sufficiently, June's already priced at 50-50. So it won't be a huge shock if they go in June to the market. And so I think I'm very open-minded to that possibility. So it's just a question of when. You were speaking in the earlier segment about how frequently they go after they start. I think that's a very important question. I think you can make the case at that point that every meeting is probably live from that point on, where you maybe don't say that about the ECB as much, or certainly the Fed as much once they get started. The Bank of England, I think that's an easier case to make, especially if inflation is back to target.
Is the Fed an outlier now?
They will be, but I don't...
You got the Riksbank, you got the S&B, potentially the Bank of England, ECB, all starting the rate-cutting cycle.
But the Fed should be an outlier in that scenario, because you've just described a few economies that are far more rate-sensitive in terms of the effect that monetary policy has on their lending markets, whether it's to consumers or to corporates, than the U.S., where people have locked in low mortgage rates on the housing side, and corporates have also locked in low interest rates for after years and years of low bond yields. They've termed out maturities, they've kept interest costs low, and it will take longer in the U.S. for the monetary policy transmission mechanism to work, just by that factor alone.
Tim, good morning. Can I ask you about what's going on with the dollar? Because you say in your notes, I don't mind a long dollar for various reasons, but not necessarily against the euro. You've got preference for a pound trade and CAD trade. We were talking just a couple of days ago, in Guy's words, about where the buck stops.
Yeah.
So are we getting to the top here?
We're getting close, and I think it's those economies like the UK, like Canada, where you can price a little bit more easing from the central bank that gets you that final push. But what we've seen over the last couple of weeks in our institutional flow indicators is absolutely massive buying of the dollar, and positions are now getting really, really full, some of the most crowded that we've seen in the last 10 years or so. And the last time they got this crowded was when the DXY topped in October 2022. And sure enough, they started to unwind those positions and the dollar started to fall. Rates were the proximate catalyst for that then. I suspect we're near the peak in U.S. rate expectations as well now. So we are getting close, but I think there's some economies on a relative basis where it probably still does make sense to own the dollar.
Is it all about the time between the Bank of England and ECB cuts and the Fed cuts?
I think it's that. It's the scale of the easing cycles that are to come and whether those are fully priced. You know, the Bank of England is not priced to do that much this year. A cut surely by August and maybe another one by the end of the year, but that's really it. Where, as I suggested before, if they get started, I think they have the cause to go every meeting, and that's definitely not priced short term.
Bonds in Asia selling off today. They sold off in the US yesterday. We had that auction of the 10-year that wasn't particularly well received. Do you like duration at this point, or does the issuance story calling that into question?
Yeah, the issuance story I don't think it's important. Don't get me wrong. It's not unimportant, but I don't think it's the driving factor. The data is the driving factor here. And the auction yesterday, I think that most of the sell-off happened actually before it. So you have a little bit of an after effect, you know, 1 or 2 basis points, but that's really just noise. I think it's all about data and whether or not the inflation data in the U.S. start to come in lower. It looks as though things have normalized quite a bit. We had, of course, the hot data in the first quarter. But I think you can still ascribe, and I think the Fed does ascribe a lot of that to residual seasonality and some of those first quarter effects, similar to what we saw last year, coming through again this year and waiting to see if that fades. So
what do you buy if the CPI print next week comes in softer than the estimates? What do you buy when it comes to debt and bonds?
I think front end of the U.S. is probably the easiest choice. You probably just buy duration as well. We've rallied a long way from the highs in yields very recently, but you know, if you get a soft CPI print, and you do need more. In the last, I think that it's true to say you do need to see more than one print. It doesn't make a trend. Yeah. But we got so oversold, especially on taking out cutting expectations for the Fed, that you can start to build a little bit more of that back in. So I think the front end's probably the easiest.
If the European central banks, though, are ahead of the Fed by some significant margin, do I just buy European equities on the back of that? It seems that people are getting much more cautious about being short of European equities than being and are looking for opportunities to get back in again. Is that the logical trade here? Rate cuts to equities, how solid is that line here in Europe?
I think it's a lot blurrier. I think the Fed is still the one around which markets will anchor. And if the Fed does have cause to be dovish, and look, the jury's still out here, but if they do have cause to be dovish, you're probably going to get your big cap names doing the best. And that favors the U.S. when it comes to the exposures in tech and communication services. If you bring the sort of post-December scenario after the Fed pivoted then back into the picture, and it's still unclear that we will, but if you do, it probably is a big cap-led rally, similar to what we saw in the first couple of months of the year.
OK. Tim Graff, really interesting. Thank you very much indeed for joining us this Thursday, bright and early, of course, Head of Macro Strategy for EMEA at State Street Global Markets. Coming up, we're going to talk to Morgan Stanley's chief UK economist, ahead, of course, of that BOE rate decision. That is next. This is Bloomberg.
I made it clear that if they go into Rafah, they haven't gone on Rafah yet. If they go into Rafah, I'm not supplying the weapons that have been used historically to deal with Rafah, to deal with the cities, to deal with that problem. We're going to continue to make sure Israel is secure in terms of Iron Dome and their ability to respond to attacks like came out of the Middle East recently.
US President Joe Biden, of course, on the ongoing conflict in the Middle East. For more on this story, let's go to Bloomberg's Horizons Mid East and Africa anchor, Jumana Batechi. Jumana, how significant is this decision out of the US and what we heard from the US President?
Good morning, Tom. Well, this is a significant step taken out of the U.S., and you have to remember that this is the first known incident of the U.S. deciding to pause the shipment of military equipment to Israel since the beginning of this war. So significant from that perspective. The background, of course, being that it emerged yesterday that the U.S. had decided to halt the shipment of 3,500 bombs to Israel in anticipation of this assault on Rafah, followed up by comments later on by U.S. President Biden in that interview with CNN, saying that the potential loss of civilian life in Rafah is, quote, just wrong. There are increasing amount of concerns over the humanitarian situation in Rafah, home to 1.5 million people. We know that yesterday Israel took over a key border crossing on the border with Egypt. About 100,000 people have already moved out of the area. But yesterday we had Mercy Aid on the show, a humanitarian aid organization, and they were saying that they estimate 1.1 million people living within Rafah are at Category 5 hunger situation, which means that they are at high risk of famine. In that sense, there is growing concern about the loss of civilian lives and the humanitarian toll this conflict is having on the Gaza Strip. The background, of course, being here that there are still ongoing talks taking place, mediated by Egypt and Qatar to get to some form of a truce deal. So there is hope still that a truce deal can be reached. But it is significant that the U.S. have decided to momentarily pause shipment of this military assistance to Israel.
Jumana, President Biden is sending a message. Are the Israelis listening? What is the Israeli response to this?
Well, the Israelis came back criticizing the decision. They were displeased, obviously, at the initiatives taken by the U.S. And by the way, it's not just the Israelis criticizing President Biden here. You also had it internally from Republican lawmakers. You had the Senate Minority Leader Mitch McConnell, in addition to the House Speaker Mike Johnson, penning a letter to President Biden criticizing this decision. But it should also be stated here that this is just a pause in this particular shipment. You remember recently that there was a bill passed through to supply further aid, military equipment, economic assistance to Israel as well. That package is separate from the decision yesterday. And so to echo some of the comments that President Biden said yesterday, he does not see this as a full break of the relationship with Israel, but just a pause and perhaps an effort for them to exert some leverage on Israel to scale back the assault on Rafah and lean in to those truce discussions.
Jumana, thank you very much. Thanks for bringing us the update. Bloomberg's Horizons Middle East and Africa anchor, Jumana Batechi, there with the latest from the Middle East. An important seeming intervention from President Biden and well worth giving everybody something to think about. So we have, if we're thinking about the day ahead then and looking at where we are on the futures picture, European stocks a little bit lighter this morning. US futures also a little lighter, down 0.2% on E-minis and Nasdaq futures. That's the market story. The big set piece event, if you like, from a macro perspective ahead is the Bank of England. Morgan Stanley's chief UK economist is forecasting a 7-2 vote split today at the Bank of England to keep rates on hold. That would be a move from the 8-1 that we got last time around. Let's talk to her now. Bruna Skarica from Morgan Stanley is with us on the programme. Bruna, good morning to you. So you're expecting one more dove to be discovered then since last month, but that still doesn't obviously change the overall calculus. We're still on hold. Is that where we get the messaging, just one more dove, or does the dovish messaging come elsewhere?
Yeah, it's a really good point. I think the key question today is precisely around the messaging. So when it comes to that additional dove, our view is that Deputy Governor Ramsden will be joining Dhingra in voting for a cut. He did give a speech recently where he outlined his view on UK inflation, the summary of which could be, it was all about energy. And as the energy shock dissipates, we expect inflation to continue to decline. But when it comes to messaging, as you rightly pointed out, the big question today is whether we see any kind of dovish innovation in the messaging. For example, do we get an addition of the majority of the MPC members think that it would be appropriate to remove some restrictiveness in the coming months? That, I think, the market would take as Governor Bailey and the majority of the MPC effectively signalling June is at play here.
OK, so we're looking for anything that tells us June is in play. That would be the new information. Is there a risk that we're wrong-footed at all by where the markets are currently pricing rate cuts, or is that not going to be something that worries the Bank of England right now? I mention this because all those reviews about BOE rate setting, or the recent ones by Ben Bernanke, have talked about the way that the Bank of England relies on market pricing in its forecasts, and sometimes the communication becomes difficult as a result.
Yeah, absolutely. The Bank of England takes the market priced curve. That has really shifted higher in recent months, not so much on UK data, but really on US data in particular. So one piece of messaging that I expect to really be reiterated today is around the differences in the macroeconomic outlook between the US and the UK. UK is not the US. So I think the implicit message to the market will be, don't treat us as a Fed beta. We can diverge here to a degree. When it comes to any kind of other surprises, look, I think there is something to be said about if we look at the forecasts at the 2-year, 3-year horizon, and these numbers are below 2%, perhaps the governor will at the press conference be asked, does this imply that you disagree with market pricing? And in the aftermath of the Bernanke review, perhaps there will be some incentive to more explicitly say, well, we do, and we do think that we might have to cut a bit more than what the market is pricing.
OK, let's finesse this now. The Bank of England has an excellent track record at communication. So how do they avoid an overreaction, sounding the market taking the message as being too dovish and therefore going too far?
Absolutely. So I think there's two elements here. The first one is just about the start of the cutting cycle, where I think the bank can say we are at very elevated levels of bank rate. I mean, historical terms, obviously, we would have to go back to well before pre-GFC for the last time when we were at 5.25. And of course, this is in response to pretty elevated inflation. But inflation is likely to get to 2% in the coming months. So I think one piece of messaging will be we are in restrictive territory and we want to remove some restrictiveness. That might happen in the coming months. But does this mean that we're going to start a cutting cycle where we'll be cutting for, by 200, 300 basis points in the coming year? We don't have confidence to signal that. So we don't want to do that. So I think it's just about the starting point versus the quantum of cuts, where I think it will be really important for the MPC to signal very clearly that starting the cutting cycle means removing restrictiveness. It does not necessarily mean going down to 2% bank rate, for example, to try and boost and stimulate the economy.
When Powell sounded dovish in December, you got a pretty clear reaction in the US economy. Financial conditions loosened, things took off again. How much clarity do these central banks have in terms of the reaction that we are going to get to rate cuts? If we get 100 basis points, 75 basis points of rate cuts this year, beginning of next year, how is the UK economy going to respond to that?
Sure. Well, Milton Friedman famously said that monetary policy lags are long and variable. So the idea that the US economy took off after, Powell somewhat hinted at rate cuts this year, I think that implies that maybe, we're thinking today that these lags are very asymmetric and very, very short, which we're not sure we have much certainty about. But near-term neutral rate is very uncertain. And that precisely goes back to the point around the quantum of cuts. So once the cutting cycle starts, I think what the MPC will be a bit more transparent about is this uncertainty around the near-term neutral rate. They already started talking about that in the February MPR. They said, well, looking at a variety of models and metrics, we think that we're about 100 basis points in restrictive territory. So I think one of the messaging that they'll try and put out there is we'll move gradually, in a gradual and moderate fashion. If you remember when they started the hiking cycle, that's precisely what they were saying in December 2021, in February 2022, and then obviously things picked up from the middle of 2022. So I think the idea will be to signal that we're moving in a gradual and moderate fashion because we don't have that much certainty around where near-term neutral is.
You see 75 basis points of cuts from the BOE this year, starting in June. We've got the growth picture coming back. We're going to get that confirmed, it seems, on Friday. So the UK is in growth trajectory. We've had that recession. It's in the rearview mirror. If they weren't to cut, the necessity to cut, if they weren't to cut, which parts of this UK economy would be most vulnerable?
Well, rate-sensitive sectors, right? Look at the RICS survey. I mean, it's pretty incredible what a big turnaround we've seen at the start of the year on the back of really anticipation of lower interest rates. Interestingly, mortgage rates have not gone down in recent months. They've actually gone up on the repricing in the front end. And, of course, the RICS survey now seems to be flatlining at levels. I believe this morning we got the data that effectively still mild declines in prices expected.
-5.
Yeah, -5.
Do you think they're worried about that on the MPC?
I don't think they're that worried about it, but it does show you that some of these rate-sensitive sectors numbers really can move quite quickly on the back of expectations of rate cuts. And if those expectations are not delivered, you're going to get a reversal in that momentum. Yeah.
You talked about the role that US data was playing in the moves that we've seen in gilts, with yields up on the back of some of that stronger data out of the US. Does that imply then, even if we get a dovish tilt from the BOE and a cut maybe in June as you forecast, that there's a cap to any bond rally, any gilt rally that comes through from higher from longer for Fed? Does that cap any potential rally in gilts?
I mean, I do think US data is very important. And even if Governor Bailey today reiterates that US outlook is different from the UK outlook, we're going to get the inflation print from the US next week. It'll be incredibly important for UK moves as well. I do think that if the Bank of England signals today that June is in play, the crucial piece of information really will be the UK inflation data still. So some near-term divergence, I think, will be possible, largely on the back of UK data.
The election. So, looks like it's probably going to be in the autumn, but it could happen in this summer. You talk to a lot of people in the housing market, and they'll tell you that the housing market basically just grinds to a halt around an election. You could see it over the summer, you could see it later on this year. What impact do you think that election could have on the data? And what impact, by extension, could it have on the cadence at which the Bank of England operates?
Well, you pointed it out, the impact on the housing market. There's normally some mild impact on business investment as well. There's a greater degree of uncertainty around the trajectory of policies moving forward. So perhaps we do see a little bit of softness on the back of that. I don't think it will be the dominant driver of any growth data in the coming months. In large parts because we do know the basic tenets of fiscal policy for both Rishi Sunak and the Conservative Party and Keir Starmer, Rachel Reeves and the Labour Party. And those are pretty centrist, let's say, set of fiscal policies from the Labour Party as well. So I would say there is a less of a degree of uncertainty around a sharp change in a fiscal policy trajectory, certainly less so than, for example, was the case in 2019 or 2017.
I was going to ask you what level of divergence do you spot then in those policies, but you say not much. So thinking about other areas of policy, and we talked earlier about the wage story in the UK and minimum wage having an impact there, as well as energy policy, of course. The wage story, the real wages story in the UK, remind us of the trajectory of that, because it feels as if real wages lag the uptick in inflation. That's what makes them, real wage increases. So where are we on that real wage story for the UK?
Yeah, I think it's a really interesting question. I think in percent a year term changes, we're currently at its peak, in my view, given my forecast for nominal wage growth and for CPI inflation. What is really interesting, and I think kind of goes underreported, is that last year, real disposable income growth, aggregate, so not average wages, but aggregate real disposable income growth actually rose by 2.2%, where average real total pay growth flatlined. So you had a slightly different dynamic in income growth and average wage growth on the back of various different factors impacting overall income. So the story around interest payments, I think, is very well known. We obviously had cost of living payments last year, which don't materialize this year. So I do think that real wage growth turning positive. It's an undeniable positive for the UK economy. We do see it slowing. However, the real disposable income growth, we think, will definitely slow this year from pretty elevated levels.
OK, so it's more than just the wages. Yeah. Bruno, thank you very much. Thanks for joining us. Bruno Scarica, Morgan Stanley's chief UK economist. And a reminder of all of the Bank of England coverage we have coming for you today. The decision comes at 12 noon, of course, London time. We'll have special coverage of that and the press conference. That's for viewers in the UK. Everyone else can watch it streaming on our Bloomberg TV YouTube channel. And we'll have analysis and commentary on the terminal at TLIV Go. So that's the blog, if you like, to pull up if you want to participate in that, if you want to get a sense of what is happening at that press conference. And that's not all. We will also have an interview with the Bank of England Governor Andrew Bailey. That's coming later today.
Coming up next, though, we're going to look at your stocks to watch at the open, including, of course, BBVA, after Spain's second largest bank launched a hostile bid for Sabadell. We get the details next. This is Bloomberg.
Welcome back to Markets Today. We have 13 minutes to go until the start of cash equities trading. The futures picture in Europe looks fairly flat. Might we see a little outperformance by London? Not really much in it, though, is there? Either side of the flat line, really. US futures pointing a little lower. NASDAQ futures down by 0.2%. We had quite a lot of tech earnings yesterday after the bell, moving things around. Let's talk to Ben Ram from the Markets Live team, and let's talk about the markets in 2 minutes. Ben, good morning to you. Let me start by getting your thoughts on the Bank of England. There's a big focus on the calendar today. We see the pound is down 0.1% against the US dollar, not a great deal of movement, currently at around, where are we, 124.81. What do we watch for and what moves do you think, Ven, in terms of UK assets on the BOE?
Morning, Anna. Today feels like the Fed 6 months ago for the BOE. Back at the end of 2023, the markets were thinking, you know what, 6 rate cuts are possible for the Fed this year. And here we are, almost at the end, at the start of May, and the markets are still thinking, when are we going to get even the first rate cut? The BOE has lessons to take away from that experience. The markets are now thinking we will get a first rate cut, possibly as early as June. Now, what is the real economic case for that? If you look at core inflation, that's bobbing around 4%, north of 4% actually. If you look at services inflation, that is at 6%. Okay, the BOE expects inflation to temporarily slow to 2% sometime in the spring, and we have to see evidence of that yet. But even by the BOE's own admission, inflation is going to accelerate after that. So where is the headroom for the BOE to go uber dovish and start cutting rates? There just isn't that kind of headroom. Because if you look at the real policy rate, adjusted for services inflation, it is actually, UK is still running a real negative policy rate. And you don't cut rates when your real policy rate is negative. Yes, the BOE may have scope to cut rates later in the year, but we will see. Which is why I'm thinking that, you know, if the BOE pivots dovishly, that will send the markets into a tizzy. It will roil the pound in the short term. Anna?
OK, so just briefly, then, the risk is that they don't cut until when? When do you think the first cut will come?
I think that the first rate cut will come probably in August. I don't think it will come in June because, you know, as I said, the BOE is expecting inflation to re-accelerate, and at least some of the more hawkish members on the committee will want to see evidence of this, that inflation is slowing beyond the second quarter. If it doesn't slow beyond the second quarter, there is no proof of sustainable inflation settling at 2%. And that sustainable is the key word today as for the markets. And that is what the markets will be watching for from the BOE statement.
Ven, thanks so much. Ben Ram from our Markets Live team. You can get plenty of thoughts on the BOE and all the other macro drivers in these markets today. MLI Vigo is the function to use on the Bloomberg terminal.
Plenty of stock action we need to be thinking about this morning. We have a hostile bid, BBVA Sabadell. Let's talk about the details of that. Joe Easton, over to you.
Morning, guys. So as you say, we have got a hostile situation over in Spain as BBVA goes directly to Sabadell shareholders offering to buy their stock in what's known as a voluntary tender. A hostile situation. They are offering one new BBVA share for every 4.83 Sabadell shares. They say that gives an equivalent price of €2.12, and that works out as a 13% premium against yesterday's closing price. Now, we can see the gain in the Sabadell share price over the past few weeks as this situation has emerged. Before this news broke, Sabadell actually traded as low as 1.4, so they are going to get a good return for those shareholders that do go ahead. We can see, though, the drop in BBVA over the past few weeks, given they would be spending around €10 billion in order to take over this smaller rival, and that has been a weight on the stock, so should get some movement there. Then staying in Spain, we've also got earnings out from Telefónica, the owner of the O2 mobile network. They're seeing an increase in earnings. Their EBITDA up almost 3%, slightly above analyst expectations as we've got on the screen. But Spain retail revenue growth is slower, and that's because they are reducing the rate at which they increase their tariffs, a positive thing for mobile users, but not their profits. They're also announcing that they've done a little deal with one of their smaller rivals, Digi Communications in Spain to try and provide some networks to them. So that could be another positive for the company. In terms of the old rivalry with Vodafone, Telefonica is the outperforming one. Vodafone's got its own issues with restructuring, but also Telefonica has been doing some of its own deals, getting out of a few areas and doing really well over in Brazil. And that seems to be a key focus in the earnings. A lot of growth in emerging markets. And as we can see, the bulls massively outweigh the bears on Telefonica. 12 buys, only 3 sells on that one today. Then in terms of home builders, we've got data from the Royal Institute of Chartered Surveyors. We're seeing a price drop in UK house prices. It is the biggest fall in 8 months that we've got on the screen. This is the white line here showing the month-on-month decline in house prices. Year on year, still pretty steady, actually in positive territory for the moment. This, though, the decline is not so good in terms of the home builders, the people that make those houses. They're all having a good run this year and over the past year. The BOE coming up later today. It's all about mortgage rates. Where will they go? People adjusting it due to the recent inflation data. That should be in focus for the sectors today.
Joe, thank you very much indeed. Jason covering some of the single stocks that we are watching. Keep an eye on what European stocks do today, because you've got to put this in context. European equities yesterday closing, guys, at record highs.
Yeah,
We've seen earnings actually looking pretty good. A lot of stories have actually popped to the upside on the back of the numbers that we've seen. A lot of equities have. Does that continue? The FTSE 100's RSI, I can't believe these words are going to come out of my mouth at the moment, appear to be indicating that we are in overbought territory.
Wow, that's something to think about, isn't it?
You don't hear that very often.
You don't hear that very often, and it's easy to focus on the negatives, and we try not to, of course. But the auto sector, of course, stood out as quite a drag on the earnings story, and it's very impressive that Europe, despite that weight of the auto sector, has managed to do as well as it has.
And the question we continue to debate, will that cut from the ECB in June, if it comes through, will that be stimulative as well? In an environment where growth is actually picking up, inflation's heading in the right direction.
Presumably that's already priced. So I think it's what comes after it that I think the market is really now waiting for in terms of the details of what we get there. And I think that's going to be the similar story today for the Bank of England. Futures muted. Tom says we're looking for a catalyst. Certainly these numbers seem to indicate that. The open, though, is next. This is Bloomberg. Thursday, the 9th of May. 2 minutes ago until the start of equity trading here in Europe. Put it in context, yesterday's close, a record for many European markets. Does that continue today? Looks like we're going to hold in there. There doesn't seem to be an indication that we are going to be seeing a sell-off at this point in time. The market still seems to have momentum around this equity market open, albeit fairly limited. But I think, given the gains that we've seen recently, actually just holding feels like actually maybe it is a win for European stocks.
And we've made the point a few times that we sort of seem to be short of catalysts right now. So the earnings story getting even more attention, perhaps. And some of that has played to Europe's favour, as you mentioned. I was looking at what did well yesterday. Food, beverage, tobacco, that was the best performing sector. We had numbers out of AB InBev, didn't we, that sort of lifted the sector.
Do we look back at this moment and think this is the pivot point where you really reallocate out of the US and into Europe? So the S&P's trading at, what, 20 times forward projected earnings profits? That's an 11% or 11% above its 10-year average. So the valuation story is rich, clearly, in the US. Less of a story here in terms of the valuations. Is this the moment where you pivot in expectation of that cut and improve in growth trajectory as well?
Are you selling the United States because you think it's expensive, or are you buying Europe because you think the catalysts are there? I think is the question, because and that feels like kind of we're dancing on a pinhead there, but I think there is a difference in that.
I'm thinking a lot about the European story and the sort of competing dynamics. You've got the sort of positives of rate cuts, but at the same time, you only get the rate cuts if the situation there deteriorates. You know, perhaps, and maybe you don't get very many if things are improving, because the data's on the upside. So it seems strange to be going into a rate cutting cycle with the data maybe bottoming out and turning better.
The data in China a little bit better on the exports. I'm watching as well the miners on the back of iron ore that got a bit of a pop. The housing story as well evolving in China. So I think we should watch the miners as well, see if there's a reaction there.
Especially as that was one of the worst performing sectors yesterday. So European equity markets then just getting up and trading. The FTSE 100 is out of the gates and not moving anywhere really. We're waiting for the Bank of England rate decision, of course. That's not that the FTSE really reflects the UK economy, but we're waiting for that in terms of UK news flow still to come. We've got the European equity markets more broadly then showing a little bit of downside. The DAX is flat. The IBEX appears to be down by 0.4%. Of course, the Spanish banking sector is very much in focus today.
BBVA is down by 5.25%.
Yeah.
That's where the weight's coming from. Sabadell is higher. It does seem as if the market is now maybe believing that this deal could be possible.
Well, that's interesting because we get another rejection. I'm just seeing across the Bloomberg terminal, Sabadell rejects BBVA takeover.
But isn't that
offer.
The whole point? That they have rejected it. We're not listening to you anymore. We're talking to your investors.
But this appears to be new. I mean, they're saying it again, but it's what they've said.
So it's a 13% premium is the offer on the all share price. So you're getting, as you say, a 6% pop in Sabadell. BBVA obviously and expectedly feeling a little pressure on this. So we continue to keep across that story, the rejection again coming through on the back of that hostile takeover. So the consolidation story again, as we've been talking about the banking space in Spain and how that evolves. Broadly across the other sectors then that we're looking at in terms of the upside coming through, energy up 0.3, personal care also getting a modest lift. But again, the downside, interestingly, coming through from autos, well, and that's a bit of profit taking after the gains that we saw yesterday, down 1.5% so far on autos. So we'll see how that shifts, if at all, through the session.
The car sector, the car sector's increasing. I find it really interesting. The talk of what is happening around China as well, I think, is fascinating. It's interesting that Volkswagen is out basically saying to the European Union, to the German government, don't put import restrictions on Chinese cars, because ultimately I think they're worried about the reciprocal impact that that could have and how it just flags how important China is to Volkswagen, some of these bigger groups, that they need to kind of regain their momentum in that market. And if they don't at this critical juncture, then that could be a real struggle to regain the momentum. So the Volkswagen's clearly worried, and maybe it actually is. It's more worried about not getting access to the Chinese market
it's their biggest market,
than the Chinese getting access to the European market.
We have an incredible lack of visibility around where, if profits are being made, obviously they are, in the auto sector. We have a real lack of visibility as to how those are allocated across different players based on geopolitics. There's such geopolitical threats hanging over that sector. And you could argue other sectors as well. Medical devices is one that's currently being investigated as well. Yeah,
absolutely. And in terms of the repatriation of profits from those businesses that are located in China as well, and whether that's a challenge more acute going forward. So we continue to keep across that story as well. The Bank of England obviously is going to be a factor in terms of the UK assets, so we look at gilts as well. Obviously the reaction function going to be more acute when the detail comes through at 12 o'clock, but currently you're seeing no movement essentially across gilts, just 1 basis point move higher at the front end, and that's potentially where it's going to be more sensitive at 4.31 on gilts.
It's a confusing morning. I suppose we're in a holding pattern, aren't we, really? Waiting for the Bank of England, what are we waiting for? Waiting for inflation data next week. Always waiting for something. I think the inflation data next week out the US is not supposed to tick down hugely. It's supposed to go from 3.5% down to 3.4%. So we are, we're not looking for a huge move there.
Let's talk about the wider picture around what is happening with markets. We have wrapped up the big conference out in California. We've had some great sound coming from the Milken conference over the last few days. Kathleen McCarthy, Blackstone, talking about what is happening with the market in terms of how she sees how the story around property, how the wider markets have played out. She feels that story is now beginning to bottom out. Let's take a listen to what she had to say.
From our perspective, we are bottoming, I would say. It's hard to ever know if you've actually hit the bottom until you're past it. But what we look at is that it feels to us that there's bad news coming, but it's mostly kind of the aftermath of the shipwreck that already happened. And when you see some of the building blocks of recovery coming into place, it feels like we're probably at the bottom.
Kind of rate sensitive, though, isn't it? If ever there was a sector that has a huge rate sensitivity to it, it is what is happening with the property space right now. And that takes us back to this idea, are we going to see a two-speed story evolving? Are we going to see the Fed, for instance, staying on hold for much, much longer? European central banks, and today we're talking about the Bank of England a great deal, but others as well, maybe looking at cuts. And does that change the way you think about equities, US versus Europe? Well, let's try and get an answer to that question. Fabiana Fedeli, CIO for Equities, Multi-Assets and Sustainability at M&G Investments, joins us now on set. Great to see you. So,
good morning.
We're starting to get European central banks cutting rates. Yesterday it was the Riksbank. Today we could get some significant hints from the Bank of England that it's getting ready to pull the trigger and deliver a series of rate cuts coming through. Is this a reason to buy European equities?
That would not be the only reason to buy European equities. What you're seeing happening in the market, earnings actually are quite okay, particularly versus expectations, and valuations are undemanding compared to other markets in the world, i.e. the U.S.
Yep.
That is the reason to buy European equities. Not everywhere. You still have to be very selective, but there are a lot of interesting names out there.
In terms of how easy it is to make that decision, it used to be quite tough, and you had to be very selective if you wanted to get it right. Is it broadening out? Is it becoming an easier decision to buy Europe? You don't have to be as perfect in your decision-making as you once were. Maybe you can think about buying broader baskets. Is that how it's evolving?
Well, you're asking an active manager, so possibly my answer will be...
Is your job getting easier, is the question I'm asking, therefore?
My job is never getting easier. I would say if interest rates come down, obviously some companies that have, like, bigger balance sheets, more complex balance sheets, will have an easier life. But we're not there yet. Interest rates will probably come down, most likely, but will probably stay also sticky for a while. So the job is not easier. But what you're seeing in the current earnings seasons, what we saw already in last earnings seasons, which is some companies are doing far better than others, for example, because they're investing more in product innovation. So there is still a lot of selection to be done, but there is a lot of opportunity.
Fabiana, you make the point in your notes that actually if you look at the World Index, MSCI World Index, 6 of the 10 best performers year to date are non-US stocks, and actually those US ones that are in there are utilities, industrial, only one technology, US technology name in the top 10. Have we been slow in the sort of commentary universe? Have we been slow to catch up with a broadening trend that from that dynamic appears to already be in train?
I'm happy you pointed that out. Yes, the trend is broadening. Last year, if you would have seen the same ranking, you would have had pretty much all tech stocks, whether in the US. In the US, it was Nvidia and Meta last year. And then China, Asia, it was really a tech fest. Now we are broadening out. Investors are looking at other areas. I mean, utilities, for example, is coming to the fore, is one of the areas where investors are starting to find a lot of value. And also they're broadening out outside of the US, which I think is a very welcome change.
And so one of the things that stood out to me also is that there's a few China names in there and Hong Kong. Gradually, we're hearing more positive things about China. Not that there's been necessarily one big catalyst for that, but various people pointing to stars aligning and the like, and feeling more favourable towards Chinese stocks. Are you also of that view?
So if you remember, at the very beginning of the year, we actually increased our exposure to China. And that was on the grounds of some improving in the macro numbers and the government being a little bit more supportive of the economy. But at the same time, valuations were at oversold levels. Now, you still have to be selective in China. Not everything is going to be rosy. But again, there are a lot of companies that are exposed to global trends that are very strong, very competitive, and are now returning also cash to shareholders, which wasn't the case in the past.
So you're being selective in China, and you're following that international exposure story. Do you follow the domestic policy as well? Do you align with the policy when it comes to investing in individual names? And are you buying A shares, H shares, or European companies with that China exposure?
So there is now a lot of value in domestic companies listed on the H share market, but also on A shares. We buy both. You do have to always take into account the domestic policy. It is very important what happens there. You have to understand where the interests of the government lie. But again, often you can still find some very interesting stories where your interests are aligned with the government, for example, in the improvement of the overall economy.
OK. And often, of course, when it comes to following the policy in China, you end up hitting against the geopolitical risk because that policy sometimes collides with what's happening out of the US. When it comes to that view, just looping back to what you were describing to Guy earlier, in terms of your relatively constructive view on European stocks, with the caveats and the need to pick stocks and maybe not buy the index, are you funding that by reducing holdings in the US, given that extended valuation you see, or do you hold? How are you thinking about the US component within the mix then?
So we are now underweight the U.S. versus international markets. We talked about China. We talked about Japan in the past.
What do you need to see to move from underweight U.S.?
Well, right now, we just see valuations in the U.S. far too demanding compared to other markets for what the fundamentals are. So I don't think it's the time to move back to the U.S. But one of the things that we're doing, because you're seeing some very outsized reactions to market expectations at the moment with the earnings season. So you have companies who are actually having decent earnings, but because those expectations are so exaggerated, you actually see a negative reaction to the price. And those are companies where we find more value, and we will rotate into them.
Why are we getting such big swings on earnings? A massive 10%, like 7, 8, 9, 10% on a daily basis on mega cap names. You must be playing havoc with your portfolios, but I'm curious to know kind of why you think that is happening and what signal that delivers about what the market thinks about what's
So first and foremost, I like to see that as an opportunity for an active investor. But this has been a trend that we've seen for some time. Maybe it's easier for retail investors to get into the market. Maybe they like those big brand names. You know, it's easier with ETFs. They really pile into larger names. That is creating more volatility, but again, also opportunity.
We're going to talk in the next part of the programme, Fabiana, about the M&A that we're seeing in the Spanish banking sector. Is this growing into something, the capital markets theme? Is it investable in some way? Is M&A as a theme investable?
Well, you always have to see why the M&A is happening. If it's happening because a company is undervalued and has very strong fundamentals, then yes, it is definitely an investable theme. And that brings me to the UK market, where we've seen like a lot of bids coming, actually not from private equity, but from trade, which really shows that this market is undervalued and has a lot of potential.
Even at new highs?
Even at new highs, there are still, from a relative valuation standpoint, it's still relatively inexpensive.
OK, Fabiana, thank you very much. Thanks for joining us. Fabiana Fedeli, CIO for Equities, Multi-Asset and Sustainability at M&G Investments.
Let's take a look at some of the biggest stocks in Europe. How are they performing? This is what the core six look like around Europe. These are the ones you want to be checking every morning to give you a kind of litmus test on what is happening with the market. Interesting that the defensive angle is to the forefront this morning. Nestlé up by 2.21%, though I have a very strange feeling that the Swiss market might be closed today. Probably need to check that. There's a bunch of European markets. I wonder whether that's yesterday's price. Schneider, ASML, both a touch higher. Ferrari and LVMH on the luxury side, a little bit lower. I've also got a wondering feeling whether or not Denmark might be closed.
Switzerland is closed and Denmark is closed. So we'll revise that board.
Yeah. Probably should have thought about that one in advance. Anyway, let's talk about some stocks that are moving. Joe, over to you.
One market that is well and truly open is the Spanish market. Banco Sabadell getting a 5% gain today. BBVA coming down around 6%. Now, BBVA doing this hostile bid, going directly to the shareholders of Sabadell, saying we want to buy that stock. Sabadell spokesperson reiterating to Bloomberg a few moments ago that they did reject that deal. But nonetheless, it is a hostile situation. We're seeing those movements. The offer is around €2.1, so we're trading below that. But potentially, we might creep higher on Sabadell. Watches of Switzerland is buying a small Italian jeweller, according to a statement just a few moments ago. I believe that is yesterday's price, I'm being told at the moment, so we're still waiting for an open, so potentially we might see some movement in that one when it does finally open. Then we got John Wood Group earnings out today, but a massive jump out of the oil engineer yesterday. They've got a takeover bid as well. The latest UK company to get a bid is John Wood, the oil engineering firm, so trimming some of those declines, actually up 0.7% at the moment. Then in terms of your earnings, we mentioned a couple. We have got Telefonica, the rate of mobile tariff increases declining. That's good news for all of us. They're way too expensive, aren't they? But then we've got ITV up 2%. Now, it used to be all about Love Island. Apparently now it's all about Hell's Kitchen. Gordon Ramsay boosting their studio revenue, according to the company today, and ITV getting a decent gain, up 2%. In terms of another energy one, we've got Harbour Energy. This is the best performer in the UK this morning. It's the North Sea oil firm. Some strong numbers out of that one this morning. But Argenx over in Belgium, they make a muscular drug, and they have got some weak earnings out today. So Argenx actually the worst performer on the stock 600 that's had a good run recently, but it's coming down at the moment. We'll take a look at a couple of the chip stocks. ARM, we're still gutted that they went to the US for that listing. They had earnings last night and they fell around 10%, so the grass isn't always greener maybe. The stock was down sharply, but we are actually seeing European chip makers gaining a bit, potentially more focus on the broader market. Chinese shares up overnight, and BE Semi down the bottom here. They've got a new order, a big order broke on the terminal earlier, but Infineon, ST Micro, ASML all higher. In terms of your UK home builders, the RICS data showed a decline in month-on-month prices. The year-on-year prices, though, were pretty steady, and the market probably looking ahead to that BOE decision at 12, so focuses on that, focuses on bond deals. Finally, one morning call just broken on the terminal. Deutsche Bank is a new buy on Barclays this morning. Now, this one's had had a good rally given the buybacks that they announced just a couple of weeks ago in their earnings, but Deutsche Bank still sees upside and they go to buy on that one, and Barclays gaining 1% in London this morning.
Joe Easton from Mercury Team, thank you very much indeed, with the Love Island fandom as well. Joe, thank you. Coming up, we're going to be talking, of course, about what's happening with BBVA, coming through with that hostile offer then for Sabadell, and both stocks, of course, moving in inverse directions on the back of that news. We'll be talking about the future of Spanish banking and what this potential takeover signals. That is next. This is Bloomberg.
I continue to think that it's over time is going to be is necessary to see more consolidation in the European banking. We may be seen as a playbook or a reference point going forward on how to merge two larger banks, but eventually what we've seen right now in Spain, at least, is a scenario in which you go through first mainly domestic consolidation, and this is a prerequisite later on maybe to expand this into a more European framework. Now, in order to do that, you need to have a banking union model.
Well, that was Sergio Amotti, of course, the CEO of UBS, speaking about potential consolidation in the banking space. Are we taking a step in that direction then? BBVA jousting with Sabadell over the last few days. The latest lines coming through this morning then, launching this hostile all-share tender offer for Sabadell. And, of course, you're getting pretty marked moves in the stocks. Unsurprisingly, on the back of this, Sabadell up around 5% and BBVA taking a bit of a knock on its stock price, down 5.5%. For the details then in the jousting that's been going on between these two banks, and again it could end up being the second largest bank alongside Santander in Spain if it goes through. Let's bring in Tom Metcalfe from our banking and finance team. Tom, why then did BBVA go hostile ultimately?
Yeah, I mean, this is a very rare move. I think the last hostile bid in Spain was in the late 1980s, so, decades ago. I think it's probably a reflection of just sort of how sour the relationships are now between these banks. The news of the deal broke, so they had to sort of move a bit quickly. But it does seem that, both sides are almost talking past each other. So Sabadell, perhaps might be open if there was an improved offer. Instead, BBVA have gone straight over the board to its shareholders with effectively exactly the same offer that the board rejected.
There's a headline crossing which I'm a bit confused about, so just maybe we'll get... So Spain opposes BBVA's hostile bid for Sabadell. That's according to a spokesperson. A spokesperson for who? Spain?
Yes. I'm guessing the regulators.
This is... yeah. Why would the government, the regulator, be opposed to this?
Yeah, I think it's because hostile bids are so unusual and obviously just bring extra trouble. Everyone knows a big bank M&A deal is extremely complicated, so you really want both sides pulling together. So, effectively with the Sabadell board rejecting this, BBVA, have to go this alone almost. And that's why it just injects that extra uncertainty. And I think from a regulatory point of view, they're like, wow, if the board don't want this, then do we really want to be injecting that into our banking system?
So the hostility involved here adds some extra tension, maybe some execution risk, because the share price is certainly trading well below what is suggested to be the offer price by BBVA. What are next steps then here, Tom? I mean, this then is in the hands of a quite international shareholder base, actually. I was looking at the sort of own function on the Bloomberg. Only 7% of Sabadell shares held in Spain, and lots around the rest of Europe. So now the international shareholder base has to decide what it wants to see here.
Yeah, exactly. 50.1% of them have to accept this offer for it to go ahead. Otherwise, it's void. I think there's some analysts out there still saying, hey, maybe the sides can start talking again. To be honest, the way this has gone down, I'll be slightly sceptical of that right at the moment. But that's probably the only way I see a sort of resolution to this. We've just seen that headline that, if the Spanish government are not keen on a hostile bid, I don't see any way this sort of goes through as a hostile bid, at least.
OK. Tom, outlining some of the challenges there. Tom, in terms of your view, take a kind of broader look at this. Is there a rational need for consolidation in Spain? And does this signal that, or are we overreading it? Does this signal potentially that we're at the cusp of some pickup in consolidation more broadly in the European banking space?
I'll echo what we just heard from Amoti. I mean, there has been consolidation in Spain, but there's more to come. It's come down from like 50, 60 banks to, 10 or so. But the sense is, for a banking system to work, you really need a handful of giants like you see in the US and to a lesser extent the UK. So, I think there is definitely a very good case for domestic consolidation. That big question of cross-border consolidation that we all want as journalists, is the most exciting story, is probably still, that is regulatory dependent. And, you see the trouble today with a domestic bank deal. Gosh, imagine how much more complicated that is for a cross-border one.
That's the issue here, isn't it? And almost if the banks are still looking domestically, doesn't that imply that they still seem to signal that doing cross-border deals is completely off the table? If you'd rather go for a really complicated deal between two Spanish banks that it's going to be hard to pursue, rather than going, are there better options around Europe? Doesn't that just tell you how hard potentially cross-border deals still are as perceived as being?
No, that's absolutely right. Much harder than a domestic deal. As hard as the BBVA Sabadell connection looks like, it actually would be a hell of a lot easier than pretty much any kind of cross-border deal that could be feasible.
So, I mean, in terms of that the banking consolidation story, we still wait, we watch, and we see if we get any news. Tom, thank you very much. Bloomberg's Tom Metcalf joining us there with the latest on the banking sector. Coming up on the programme, our exclusive conversation with the Google DeepMind CEO and co-founder Demis Hassabis. Also earlier this week, we heard from the head of the Global Vaccine Alliance, that's Gavi, on the possibilities of AI in the health sector moving forward.
AI can fold months of work into seconds, literally. We've got country focal persons, and people are really overwhelmed with work. And I think some of these some of what the LLM modules can offer, which are very basic, even open source, can be transformative for the way we execute at the last mile. I think it's a question of institutionalizing them, having a different mindset. I mean, we as an entity have to be constantly prepared for a next outbreak, for a next pandemic. The reference point is that if there's another pandemic, we should be able to just switch on the light of a control room and take our seats and operate.
Sanya Nishtar, the CEO of Gavi, the Vaccine Alliance. And Tom, this opens up very nicely into our next conversation we're going to have after the break, which is the role of AI in healthcare. She's talking about last-mile delivery of vaccines and how AI can make a job that usually takes months. It can allow it to be done in just minutes, which is quite incredible.
And if you can shorten the time around R&D, then that will be consequential as well. And that's where the likes of DeepMind, Google DeepMind, hope they can play a really significant role, particularly with the upgrade to this software system, this AI software system called AlphaFold 3. So we spoke exclusively to Demis Hassabis about this. And in fact, what they're able to do now is predict the way that different proteins interact with things like RNA. So, of course, when we think of COVID vaccines, we think of mRNA. So that could be really consequential in terms of vaccines, but more broadly as well in terms of healthcare.
This conversation then continues after the break. We're going to play you a substantial part of Tom's interview with the Google DeepMind CEO and co-founder, Demis Hassabis. We'll bring that conversation to you. Really exciting to carry on these conversations then about AI and health. That's coming up. This is Bloomberg. Welcome back. This is Markets Today, 30 minutes into our European trading session. We are pretty flat on these markets, down 0.1% on the Stock 600. The CAC 40 is entirely flat. The German market making modest gains. The IBEX is under pressure, down by just over 1%. A lot of that has, of course, to do with the Spanish banking sector and the M&A story and the hostility around that developing there. The FTSE is pretty flat, so we're going nowhere in a hurry, seems to be the summary.
It felt like it yesterday. Yesterday was definitely a session in need of a catalyst, but actually equity markets
did okay.
Powered higher in the absence of anything kind of obvious, but earnings were the apparent catalyst. Today, I'm not even sure we have the earnings story really, to kind of get us going.
The AI story didn't come through either in terms of ARM. So there's a lot of expectations. And the earnings weren't that bad. But again, it talks to that expectations story.
US earnings actually were quite weak yesterday.
Yes.
That was the narrative that we got. So ARM didn't look particularly good as well. Airbnb, massive reaction. That feels like a sort of seasonality factor. But I think expectation had got pretty high around Airbnb. So there was some weakness there as well. So the US earnings season didn't look good. The European earnings looks much better yesterday. Stocks like Puma doing really well, powering the market a little bit higher. But today, I'm not even sure I've got that. I've got a lot of ex-dividends. I've got a lot of markets closed. We need a Bank of England maybe is going to be the catalyst. I don't know. Screaming out for that catalyst, the BOE or the inflation data out of the US. But yeah, it does look like we're looking for that.
We've got a lot of days. We've got a lot of hours of programme.
Looking despondent.
To get through, yeah.
Do not be despondent, though, because we can go back to the AI conversation. So I had this exclusive. We touched on this. We've teased it, which is great. We had this exclusive conversation with Demis Hassabis from Google DeepMind, the co-founder, the CEO. By the way, all of the AI components within Alphabet now report up to Demis. So he's taken on this additional power. He is essentially Alphabet's AI chief right now as well. But we had this exclusive conversation because they've launched this new software platform. They had something called AlphaFold, which could predict protein structures. They've come out with something called AlphaFold 3, which can predict not just protein structures, but how they interact with other molecules like RNA and DNA. The consequences could be really significant. Take a listen to what Demis Hassabis had to say about some of these changes, and more broadly as well, his views on how AI and generative AI is evolving.
Of course, biology is, as we know, is a dynamic system. Really, all the emergent properties of biology and life are due to interactions between different molecules and different structures. So that's what AlphaFold 3 is about, is a first step in that direction, understanding this dynamic picture and understanding what proteins interact with and how they interact with those other types of molecules. So not just other proteins, but also DNA and RNA, like you said.
And for the medical world, and in terms of drug discovery, how significant do you think this could be in the months and years ahead?
Well, of course, the holy grail for drug discovery is not just knowing the protein structure, which is what AlphaFold 2 did, but actually designing drug compounds called ligands that bind to the protein surface. And you want to know where it binds and how strongly it binds in order for you to design the right kind of drug compound. So AlphaFold 3 is a big step in that direction of predicting protein ligand binding and how that interaction will work.
Given the technology you now have at your fingertips and everything you know about how this is progressing, what is your best guess as to what will be the first AI-derived and discovered drug?
Yeah. Well, we announced earlier on this year some big partnerships with Eli Lilly and Novartis. So we're already working on real drug programs. And I would be expecting maybe in the next couple of years the first AI sort of designed drugs in the clinic.
That's really interesting. In the next couple of years. Isomorphic Labs, look, I know this is a passion of yours. You oversee this unit. It's a separate business, but under the Alphabet family, of course. Yes. And it's that generative AI or AI-developed drugs. And you have those partnerships, as you say, Novartis, I should say, and Eli Lilly. Up to $3 billion of revenue. Does AlphaFold 3 get you closer to unlocking that revenue with those commercial partners?
Yeah, it's a critical part of the tools that we have at Isomorphic. We also have some other AI systems that fill out this space of drug discovery. There's a lot of different techniques and modules that are needed in order to cover the whole of that a very difficult process. AlphaFold 2 and the protein structure was just one small component of that. And you can think of Isomorphic building many tools that fill that out, moving more into things like biochemistry and chemistry so that we can design the right drug compounds.
And you've talked about being in a low data regime. And when we think about what's needed for generative AI, huge amounts of data, of course, and for some, not all, but for some copyrighted data, but also huge amounts of energy, electricity, water, and huge amounts of cash. Are the foundations of generative AI challenged when it comes to the sustainability of this?
I think that the benefits that the generative AI models that we build, things like drug discovery and other stuff, that is going to far outweigh these costs, I think, in the long run. So including even on things like energy and climate, where I think AI has a huge potential to help with that. derive more efficiency from our power grids, inventing new materials, new technologies, clean technologies, things like helping with fusion. I think that AI can be applied to many of these areas and be extraordinarily productive and helpful in all these areas and far outweigh the costs and efforts that are involved in building these models.
So it can be sustainable, and you don't see these as major roadblocks. I mean, particularly the energy component and the shortage of data now.
Well, look, there's challenges. There's always is in research, and we've got to be innovative to figure out our ways around that and how to do that. You know, for example, the data question, there's lots of interesting work going on with things like synthetic data and how to generate, self-generate data. And we're actually experts in that from the past with our gaming work, where, you know, if you take our programs like AlphaGo, that was self-learning, self-improving through playing against itself. So in effect, it was generating its own data. And I think some of those kinds of techniques can be transferred over to the new world of, you know, generative models and large language models.
Broadly, across what's happening with generative AI, the critics, the skeptics say, look, there's a lot of hype involved, and we have seen companies like Stability AI, they've been challenged with their finances. The likes of Inflection being absorbed by Microsoft. Are we at a point now where we're seeing a little bit more rationalization, where we should look to maybe see more closures, more failures, more acquisitions?
I think, funnily enough, in many ways, I think AI is overhyped in the short term and probably underestimated over the long term, like what it's going to bring. And I think that's probably true of a lot of breakthrough technologies. So I think we're seeing, because of the popularity of AI now in the last couple of years, lots of people trying to get into this space who maybe haven't thought about this as long as people like us who've been in it for decades. And I think we're going to see a sort of rationalization process happening. But I actually think what it's going to end up delivering is going to be even beyond what the most optimistic end of things that we can see are in the near term. But in the longer term, I think there's going to be enormous benefits and enormous opportunities. But you know, as with any new market and new technology, there'll be a lot of twists and turns on the way there.
As we look to the end of the year, so much changes within this space, so much evolution, so much innovation. What are the kind of changes, what are the big things that you think are going to come about between now and the end of this year that you've got on your radar?
Well, look, I think there are huge things in the science space. You know, I'm very excited about what isomorphic's doing and what AlphaFold 3 can do with drug discovery. I'm also really excited about the next stage of these large general models. You know, I think the next things we're going to see, perhaps this year, perhaps next year, is more agent-like behavior. So systems that are able not only to just, you know, answer questions for you, but actually plan and act in the world and solve goals. You know, and I think those are the things that will make these systems sort of the next level of usefulness in terms of being a useful everyday assistant, for example.
So those AI agents are maybe 1 to 2 years away in terms of having that utility.
Yeah, I mean, we're working hard on that. Others are too. And again, that's bringing back in some of our work we did years ago with gaming, which were all agent systems, you know, achieving certain goals and objectives, bringing that kind of work and marrying that together with the modern, large, multimodal model work.
Bring it back to isomorphic labs, because this is where a lot of this started in terms of drug discovery and the conversation there. Are you under pressure when it comes to isomorphic labs to commercialize these products? What is the potential revenue stream of that unit?
Well, I think first and foremost, you know, I think it's the most beneficial thing. If you ask me the number one thing AI can do for humanity, it will be to solve, you know, hundreds of terrible diseases. You know, I can't imagine a better use case for AI. So that's partly the motivation, you know, behind isomorphic and AlphaFold and all the work we do in science, is to advance society and benefit society in these big ways. But I also think that if you could revolutionize drug discovery process, make it 10x faster and more efficient and more likely to pass through the clinical trials because you can predict the properties better, that has to also be enormously of an enormous commercial value too. So I hope to do both with isomorphic, you know, build a multi, $100 billion business. I think it has that potential, as well as be incredibly beneficial for society and humanity.
OK, Google DeepMind co-founder Demis Hassabis there on AI software breakthroughs in bioresearch and what it could mean for the pharmaceutical industry, on which we bring in, of course, our expert Sam Fazeli in-house from Bloomberg Intelligence on what this actually could mean in terms of AI-developed and AI-generated drugs. Sam, given what you've heard from Demis Hassabis there, he thinks, and this is what really surprised me, was the time frame he gave when I asked him, when do you think the first AI-developed drug will come through? And he said 1 to 2 years. And then he said Isomorphic Labs, which sits under the Alphabet family, which is specifically focused on that job, could be worth in the hundreds of billions of US dollars. Is that time frame, let's start there, is the time frame realistic? Sam?
Well, so first of all, I have to say you've just talked to one of the luminaries in the space. So, you know, he is absolutely on top of everything that you've just been talking about. The reality is slightly different, though, because any drug that's discovered by any method, be it an AI system or a human neural network, let's put it that way, but of course they can scale much more than putting 5,000 humans doing the same job, is going to have to go through the rigor of testing, preclinical testing, and getting to the clinical trials, which can take anything from 5 to 10 years, depending on what sort of disease you're trying to treat. If you're cancer, you haven't got another choice, you go early, you treat a whole group, a smaller group of people, you can get through quicker. So a lot of it depends on that. He did say something very important, of course, that if the AI system is able to identify drugs that have less risk of failure, so that when you put them in the mice or in the monkeys or in whatever model you have to do before you're allowed to put it into humans, and there's no untoward effect, faster and more likelihood of getting through it, then you increase your probability of success. If you go into the first human, usually healthy volunteers, and nothing happens, and you go to the patients, that's where you've got the win. That's where a lot of drugs keep failing. And, of course, your prediction of whether it's going to work or not is another element.
This is all predictive, and this is modelling. How much does the system not understand about cell biology, cell chemistry? And when it doesn't understand something, how does it deal with? Because in theory, you could just design entire drugs, test them on humans, all within the computer. But I'm assuming that there are bits that we don't know, which is why we're going to continue to test on humans.
You mean the famous unknown unknowns?
Yeah, we're going to get Rumsfeld about it. Yes.
Now, so there's two. I would answer that in two ways. One is, if you don't know, you just don't know. If there's no biology deciphered on it, you won't know.
But there must be structures within the cell that the system cannot understand.
If no one's ever looked at them, although it has got predictive capability, which is, I think, what's fascinating here. Sure. What is more interesting for me is that there is such a massive body of science. If I showed you how many papers are published on a single day from scientists across the world sharing their information and data, and how you synthesize that information, and people like you and I have biases. Hopefully the AI system doesn't have biases. I'm an immunologist. I'm going to keep looking at stuff related to immunology. What if there's an important piece of information that came out of some genomics somewhere that I haven't connected with because it's not my forte? The machine doesn't care about that. It looks at the information and tries to find missing links and putting links together. That's where I think the real power of this is, in that massive data analysis.
OK, so in drug development, clearly some really exciting opportunities ahead. Sam, I was speaking earlier this week, and we played a clip of it earlier, to the CEO of Gavi. And, you know, this is all about vaccine distribution and the Vaccine Alliance. And she was talking to us about last-mile distribution and how AI could play a really important role there. She was saying that you can take jobs that previously would take months to work out how you do that last-mile distribution of those vaccines, and you can do it in seconds using, actually, AI technologies that already exist. So in some parts of the world, AI and health can already be coming together. This isn't something that takes 2 years. This is something that might deliver real results soon.
Absolutely. I mean, if you want to take it much broader than drug discovery, every aspect of the pharmaceutical product development chain, from going into clinical trials, writing applications to the FDA, organizing clinical trials, running them, capturing the data, analyzing it fast and real time, every single one of them, then supply chain, manufacturing, everything can be touched by that.
Sam, across the pharmaceutical companies that you look at, how seriously are they taking this AI question? To what extent are they embedding it into their systems? To what extent is DeepMind and companies like Alphabet a threat or a partner to them?
You know, I think, to answer your last question first, they are not a threat. These guys, pharma companies, are all over anyone who can give them a new drug. And if that looks like, you know, M&A, licensing, whatever, so which is what already Isomorphic has done. Couple of deals. Yes. He mentioned Novartis and I think Eli Lilly. Yeah. So that's not a problem. They love that. The question is, inside, how are they applying this? I don't think there's a single pharma company that isn't or hasn't looked at this. And let's not forget, it's not just about AI. It's about machine learning. It's about just being able to have good digital systems where people can talk to each other, for example. You know, one of our successes is obviously the Bloomberg chat. And so, you know, those kind of systems within pharma companies, allowing the analysis of data as soon as it appears in one place in Raleigh, New Jersey, being accessible to people based in Stevenage, for instance, those are already happening.
Raleigh, New Jersey and Stevenage. It's not a connection you
Those are the two hotbeds of, I think, pharma companies.
Excellent.
Or near Stevenage.
OK. Yeah. In the environs of Stevenage. Sam, great stuff. Thank you very much indeed. Sam Fazeli from Bloomberg Intelligence. This is the good stuff from AI.
The good AI
the good AI. It's going to benefit us all. We're going to get drugs much more quickly. They're going to be much better. We're going to save humankind. Creativity. Apple has got a bit of a problem. This new advert that they've put out for the new iPad, which has these super fast chips, the idea is, I think the idea is that it's basically kind of is going to do all these things like pianos and paintbrushes. Oh. But everybody's falling out with this advert.
I don't mind them crushing the metronome, but everything else in this video upsets me.
So it's the
crushing creativity, basically. And this is so a lot of people have really kicked up a stink about this. This looks like a significant own goal for Apple. You're crushing
guitars.
All of the great things that we as humans create.
Absolutely. All that culture, all that creativity crushed there, and replaced by a bit of tech. And that's the point. It does tap into our fears. There's the hope around AI and around healthcare. That could be incredible, as Sam has suggested. But there is also the crushing sense that creativity is under threat. I mean, I played plenty of music growing up, and keep music live was always a mantra back then, and this was decades ago. It means even more now.
Yeah, Tim Cook posting this apparently on his own X account on one of the social media channels, and as you say, facing a lot of pushback. The creative industries are already freaking out about this, and we saw that with the writers' strike, didn't we, in the US, and the fact that they encoded it in their deal with the big Hollywood studios.
Absolutely. But Apple's always been perceived as being the friend of the creative.
Yeah.
Yes.
We have generated tools that will allow you to be
more creative
and do better things, and it's going to augment rather than hurt what you do. It'd be really interesting to see how they deal with this. Apple is facing challenges on multiple fronts at the moment.
Multiple challenges. And talking about tech, we're going to be speaking later to ARM's Chief Executive, Rene Haas. He'll be speaking, in fact, with colleagues Ed Ludlow and Caroline Hyde over in the United States. That's at 4 London time. That's part of Bloomberg Technology, an event taking place in San Francisco, bringing together leading CEOs, tech visionaries and industry icons. We'll be coming back to you with the latest on the BOE. Will it deliver a boost to British households? That's next. This is Bloomberg. This is Markets Today. We are 51 minutes into a European equity session that shows some outperformance in London, some underperformance in Madrid. We'll get to the Madrid story shortly. Let's focus in on the macro themes here in the UK. Bank of England Day, of course. Will Governor Andrew Bailey deliver a lift to British consumers with a stronger signal on when borrowing costs might be cut from their 16-year high? Let's ask Lizzie Burden. Bloomberg's Lizzie Burden joins us on set right now as we run up to the Bank of England. Lizzie, good morning once again. So what clues are we looking for then in terms of this dovish messaging from the Bank of England? There's a danger we don't get that and they just say it's all about the data, but what are you looking for?
Of course they'll tell us that they're data dependent. When don't they tell us that they're data dependent at these central bank meetings recently? But in terms of the clues as to the path beyond that first cut, look at the guidance. Does the wording change? Do they say that cuts are coming in the coming months? Or even do they just say, look at certain data points and use that as a hint to whether it's going to be June or August? That's been the ECB's approach. Then listen to the press conference as well, any clues from Andrew Bailey. Look at the vote split. Does Deputy Governor Dave Ramsden join Swati Dhingra in voting to cut today? And look at the forecast as well. Do they actually reduce where they see inflation in the future beneath the 2% target to push back against the market curve and say actually it's too cautious right now?
What kind of reaction do they want from the markets? The Bank of England has struggled to communicate with the market and not get big reactions. Do they want a little reaction today? Do they need to see a significant repricing? What do you think the bank is anticipating from its messaging?
You would think, ideally, they'd want to communicate the dovish tilt that we've heard in recent speeches, but not go too far in that direction. They don't want an overreaction in the markets.
Yeah.
And the markets currently, it's cautious, the mood. At the moment, they're fully pricing an August cut. June is only about 40% priced. If they're going to go in June, they want to have bond traders adding to that bet, right? This is the last opportunity to lay the groundwork for June with a press conference. I think it's interesting, you could see weakness in sterling, a boost to gilts if you have this dovish tilt in the forecast, etc. But it seems to have been a bit overplayed in the case of the Bank of England, that if you have that currency weakness, it would refuel inflation in Europe. Because, first of all, Andrew Bailey's already said that the ECB and the Bank of England are more similar in the inflation that they're tackling than the Bank of England and the Fed. But also, when you think about how much trade the UK does with Europe, it's much bigger than with the US. So it's the pound-euro relationship that matters more so than cable to the inflation story.
OK, Bloomberg's Lizzie Burden breaking down what to look for then and in terms of the potential market impact. As we look at the pound, a little weaker so far in the session at 124, down 0.2% versus the US dollar, not the euro right now. The gilt 10-year currently a little bit mover in terms of yields up 3 basis points, 4.17 on the 10-year. So a little bit of selling pressure coming through. Yields up 3 to 4 basis points. The Bank of England's decision, of course, coming at 12 p.m. London time. We're going to have special coverage, of course, of that and the press conference for viewers here in the UK. It will also be streamed on our Bloomberg TV YouTube channel as well. And we're going to have analysis and commentary on the terminal at T Live Go. Later today, we're also going to bring you an interview with the BOE Governor, Andrew Bailey. So something to look out for as well, of course, what Andrew Bailey has to say, whether he reiterates the kind of dovish, at least inflation-sensitive lines that came through at the IMF, where, again, as Lizzie was saying, he suggested the inflation dynamics here in the UK are very different to those in the US.
And Bruna Skarica was picking up on that earlier, wasn't she, from Morgan Stanley? I liked her line, similar to Lizzie, making the same point as Lizzie about it being more Europe that matters than the US, saying don't treat us like a beta to the Fed, and that's maybe another message that we get from Bailey coming through today. Yeah.
I think if the Fed doesn't do anything this year, then I think you probably need to factor the Fed into your thinking. So I think it was Holtzman earlier today talking about the Fed being the gorilla in the room still. I don't think you could ignore the gorilla in the room. It's a very bad idea to ignore the gorilla in the room.
When we're talking about the rates environment, I wonder how it factors into the decision to go for a bid by BBVA, Sabadell. That story unfolding, of course, the rates environment becoming less benign, arguably, if rates come down for these banks. So the detail, of course, they've come through with this hostile bid. That was the big news story that crossed a couple of hours ago. BBVA coming through with a hostile bid, Sabadell, an all-share deal, and we see the reaction on the share price for both these banks then.
It's fascinating to see kind of the reaction. The market is clearly signalling that there is a greater possibility now they've gone hostile, but not a significant kind of probability that this deal is going to happen.
Yeah, because we're not trading anywhere near the offer price. So 187 is not over €2. And the Spanish government really pushing back against this. And if you look at the reasoning, they're saying it would negatively impact employment and financial services, potentially adding risk for financial stability. They call it excessive consolidation. So this isn't about the hostility, it's just about consolidation.
Well, I think I think the hostility would be really difficult. This is you have to take out so many costs in this business. To do it with an unfriendly counterparty would be quite difficult.
Excessive consolidation in a market with 10 banks of that size, as Tom Metcalf was outlining for us. That is it for markets today.
You can go. The Pulse is next. I'll go. The Pulse is next. Francine will be taking over. We're counting you down to the Bank of England. This is Bloomberg.